Good evening, traders. Welcome to Admiral Markets webinar. We're going to dive into how to practically handle your fear while trading. My name is Chris, and Nennet, of course, is with us today as well as we dive into this educational topic about trading psychology. Before we dive into the topic, though, be aware that this webinar is shown to a global audience but may not be suitable for everyone. Take a look at admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity to find out more information about that. Also, please be aware that trading for exchange and global financial markets in general are considered high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. And by continuing watching this webinar, you agree with this disclaimer, plus you're aware of the risk involved when trading. Alrighty, fear in trading, maybe it's a bit of a cliche, almost. I mean, a lot of things are said about it, written about it. So from that point of view, maybe not that exciting, but it is actually a very important part of trading psychology and trading in general. I mean, let's face it, we all have it at some point or another. Obviously, maybe more when you just started out, or maybe actually after you've traded for a while. Ironically enough, if you just start out, maybe you don't even know what to be scared of. And as you get a bit more experience, you bump into all kind of experiences that you've gone through, and then kind of the fear starts to creep in. Now that could be different for everyone. Some might have fear for certain trading situations from the start. At some point, we're going to bump into it, right? Because the markets are just very volatile. There's a lot of movements up and down consistently. So we all have our weaknesses as well. So we're going to, the market is going to push our buttons, and they're going to find a spot where we feel less comfortable. Whether it's entering the market or exiting, we're going to bump into that at one point. Now that fear basically is visible at different spots. Whether we're greedy or fearful, we have our own bias. We have our own bias when we're over or underconfident. For instance, here I'm writing in the left lower corner that some traders are overconfident of their ability to trade the markets. And they assume that they must be right and the markets must be wrong. Others are perhaps a bit more insecure towards the market, and they're maybe more hesitant, and they might be thinking, I'm always wrong, the market's always right, right? Now, in fact, the whole idea of being right or wrong is very hazardous, and we'll dive into that later on. There is actually nothing of the sort. The market is just a market. It's a neutral object there, and it provides an opportunity for traders to lose and win money. And it's all about that. It's all about being profitable or not. And whether we are right or wrong, or we should have been right or wrong, or really just hot air discussions. Okay? Now, what does fear do with us? Well, it does a lot of nasty kind of things. We're overly cautious, overly hesitant, right? That's the point one. We try to avoid mistakes. We try to be right all the time. We choke a bit under that pressure. There's a flight or fight response, which means that, for instance, the flight response could be that we close the trade too early. The fight response could be that we actually add a trade and over risk. And we get distressed, and we could have a freeze out. A freeze basically that what happens when we're in such a fearful state that we cannot process information anymore. We are not having a flexibility and an open mindset. We're looking at the charts, and all we can think about is one thing, and is that we're scared, and we cannot welcome and interpret what's going on anymore. And to basically escape that awful situation, we close the trade probably, and we relieve ourselves of this dreadful situation we're in. Because by exiting the trade, we don't have that feeling of that feeling of fear. That feeling of fear disappears after a few minutes, and then when we realize and regain consciousness of what happened, we are in retrospect mad at ourselves, right? Like, oh, why did I close that trade? What was I thinking? And it was just a natural response to get rid of that fear. And it makes sense. I mean, throughout our history, fear it was a good warning, right? It was a good warning. When a lion was around the corner, well, it was good to be fearful because it made you uh, fight or flight, and that was needed as a self-defense mechanism. All right, so that was all good. But now with trading, if you want to master something, as you know, effort is required, obviously. And in this effort curve as a trader, we want to get to a point where we can at least handle the fear. All right, and I'll talk about that a bit more. When does fear occur? And it could be very, very different from trader to trader. It could be entering a setup. I, for instance, had it when price was actually getting close to my target, right? In the past, not so much now, to be honest. But I still like, get a bit antsy, right? I get a bit nervous. Like, it's only five, it's only 2 pips away, and even still, I'm like, I'm not gonna fight for those 1.5 pips. I'll take the profit. So, and that's when I'm watching the chart. Like if I'm not watching it, if I'm around the corner but I'm not keeping an eye on it that single moment, and I come back and the TP, the take profit level has been hit, great. I'm happy, right? I don't have to see it getting close to that target. That's my weakness. Others could have it with entering or exiting a setup. You could have it when the trade is in negative territory or when price is showing indecision. You might have difficulty to pull the trigger and enter a setup, when you have doubts about a setup. All these things play into factor. Different traders could have different problems, right? Basically, though, there are a number of categories we can use to summarize groups of fears, and then we'll dive into how to solve it. We could have fear of losing. Let's start in the left upper corner. Fear of losing is basically the thought that when we enter, we should win that trade, all those trades. We should not bump into a losing trade. There's that pressure to make sure that each and every trade is a win. But I've got news for everyone. We are not fortune tellers. It's impossible to win every trade in your life. You can have a win streak, and that's great, but it's not going to last forever. I got news for you, and I got going to dispel that notion, right? That's not going to happen. So losses are a part of the game. Losses in that way are a necessity to have long-term profit. Because if you stop the moment you have one loss, well, the trading career is not going to last very long. We have to be able to handle a loss. And also, we must realize that if we're unnaturally getting wins by cutting trades short, that this is self-destructive in the long term because our wins are not going to be compensating those losses. So we need to have trust in our system and also trust in ourselves to implement that system. And we need to have the realization that trading is without doubt a probabilities game. And we don't use probability in our life too much because everything is quite, or for many of us at least, it is quite routine. When we sit in a car, we do not trust, we do not think about the risk of driving. We don't think, okay, there's a 0.0001% chance that the tire will leak. Or if you cross the street, there's a 0.0001% that I might get hit by a car, unfortunately. I don't want to think about all these negative things, but we don't think about, the chances of these things occurring. All right. Now you might think about it if you go parachute jumping. You might think, "Oh, that's a bit risky." You might start thinking. You might look up some statistics. How many times does this go well? But in normal life, we don't think about it. Well, in trading, it's definitely a probabilities game. Fear of missing out, fear of being wrong, and fear of losses. Fear of missing out is when we have wished to be in the trade, thought we should have been in the trade, still want to join the trade. All kind of emotions go into us just because we thought that trade was good and we're not in it, right? So that's kind of building up pressure in that way. Fear of being wrong, I already talked about it a bit, is that just a fear of taking a trade and it's turning out to be a loss, and it's not even the loss that's that bad, but we were proven wrong in our analysis, or whatever the thoughts are, is very common. Fear of losses, basically, what happens is when you're in loss, we become actually very risk adverse, and when we're winning, we started to take actually no wait, uh, it's the other way around. Excuse me, I wrote it wrong here. The You actually become more risk averse when you're winning. So that's why you see that also traders have smaller wins because they're in profitable territory, so they become more risk averse. Whereas if you're in losing territory, if you're actually in negative territory, often enough traders tend to become more risk takers, probably to regain what they lost back. Revenge trading, for instance. So they become more risk taker when they're actually down. And the bigger that drawdown becomes, almost the more acceleration you get in that willingness to take risk. That's why it's so important to limit the risk per day, because if you don't have any boundaries, psychology rule here says that we're more prone to take more risk. If we can limit the risk to, let's say, 2% in a day, we're willing to accept it. But if it goes down all the way to 10%, there could be something snapping in us that says, I'm not going to accept that 10%. And you're going to double down, take more risk, you become more aggressive, the tolerance for risk, the borders disappear, you get emotionally involved, and before you know that, that 10% drawdown is 25. And you don't want to accept 25, so you keep going, and before you know, the account is blown up. That's why blow-ups happen, because the psychology changes. We lose reality, grasp of reality, and we just become bigger risk takers. All right, so those are types of fears. Now, Alif is saying, I cannot trust in my system. Is there any way to prove my trading system is right or not? The best way is to either trade a demo, if you're okay with that, or trade with a real account with low risk. Trade your system as you think the system should be traded. Trade it for 40 to 50 trades. Then look at the statistics and make your judgment. The best is really looking at a decent sample size. Now, I say 40 to 50. Why? Because that's actually a number that statistically will say something to you. It's a small size, but it's enough to give you real concrete feedback about how it's doing. All right? So, fear. And certain situations, as I said, it could be good. It could be a warning. Sometimes we, can get a gut feeling, and that could be a clue for us, and it could be a potential mistake that has been made, let's say. But this is typically more for experienced traders. When less experienced traders have this, it really doesn't correlate necessarily to anything substantial that is important, in most cases at least. If you're experienced and you got a lot of years under your belt, a lot of trades under your belt, well, that could be a very good radar and a clue. But many times fear is destructive, as I'm writing here, as you can see. So let's talk about how let's talk about a battle plan, how we can tackle this issue and organize ourselves in a way that we become better and better at handling the fear. First step is knowing yourself, and might sound a bit, I don't know, a bit awkward in a way. What I mean is that we want to know what type of trader we are. We want to realize what is natural to us, what are our strengths and weaknesses. We might be great in staying in for a long trade. You might have a lot of patience in that, right? But you might be weak in setting a very tight stop loss because you just have a feeling that a tighter stop loss is in your system the best. Well, it might not be the case. We also want to have a clear idea of what our trading plan is. All right, we don't want to be guessing around when we're trading. You got to have a clear-cut trading plan that you're going to try for those 40 to 50 trades. Then you want to see, is there a match or a mismatch between how you are as a trader and your trading plan? Are you comfortable with your trading plan? Are you breaking the rules? Are you sticking to the rules? And why? Think about it more deeply, analyze that, and then try to give that feedback back, all right, to your plan and to yourself, and try to make it a better match. When you have a good match, all right, so this will take some time. You are at least in a spot where your trading psychology and your trading plan are not uh, contrary to each other. They're supporting each other more or less. And although you'll still be monitoring this, you got a good base to work with. And then you can move on and you know tackle the fear factor a bit more by setting up goals and setting up a tracking system. The importance of matching the psychology is very important because often enough you're going to find a system or make a system and it's just not the thing that suits you, and it's not your fault, and it's just something that somehow is not in your stream of how you trade, and that's okay. Now then again, that's one side. The other side is that traders are giving up systems within 2 3 trades and are moving on to something new. That is also not good. Switching strategies that fast doesn't make sense either because then you'll never be able to understand if there is a match. All right. So you at the start, yes, you can actually do some switching because you want to, test some different indicators. That's all fine. Give yourself whatever, weeks, months to do that. Then you got to settle down, choose a system that you think makes sense or two, and test that rigorously for 40 to 50 trades, and then go back and see is that something for you or not. And then you can again change it and test it again 40 to 50 trades. No, you don't need to have multiple strategies for different market conditions. You can have one strategy and only trade that strategy with that market condition. So you would have one strategy, and if that market condition is not suitable for your strategy, don't trade. Or look at other currency pairs or instruments, right? We got a ton of currency pairs. If you're looking for a trending environment, but the euro dollar is not trending, maybe the pound dollar is trending or the odd USD is trending. You don't only have to trade that pair. Alrighty. Knowing yourself. Basically, what you want to do when you're actually trading is you want to track what you're thinking at the time of trading. Now, you're going to be talking to yourself, self-talk. There's going to be some subconscious discussion in your mind about what's going on. Should I have taken that trade? I forgot about looking at the daily chart resistance. Oh, why didn't I think about that? And I look at the chart and there it is. This trade is never going to work out. What was I thinking at the time I entered? All these discussions are going in our mind when we're trading. So you want to write that down. Not everything necessarily, but at least make a nice summary and track when you have that fear. When does it pop up? All right. Then you want to analyze it. What's causing it? Why is it there? Why was I not happy with all the decisions I took? All right. And you want to use that info for making your psychology plan. Now, when you're going through that thought process, you want to analyze, is it negative or positive thinking? At what moments is it negative or positive? Is there are you applying a more defensive posture, or are you learning and having an open attitude towards trading? Are you like a child approaching some new topic and full of questions, or are you there to let the market prove yourself right? All right. If you're like that, that's a defensive posture. You want to basically approach the markets in a way that you know everything can happen. There's nothing is a guarantee. All right, that's something that's important. That's something you want to measure if you're doing or not. Do you have kind of the approach that you are right or wrong? Are you having positive visualizations in your mind? Are you approaching it with a probabilistic mindset? These are just a few things you can measure when you're analyzing yourself. And once you write this down and start to, you'll get a better feeling of what's happening with yourself, with your mind as you trade, and you could get that info that's needed to make an analysis about knowing yourself. All right, that's important. Now, your plan, I'm not going to talk about your plan here because that's again a different topic, right? Um, so basically, what is the end goal, or where do we what where do we want to go to? How do we want to end up? What kind of trader do we actually would like to become when we're reasonably in control of our fear? What will happen eventually is that when you have tested the system and you've been tweaking it and working on it, and you're getting rid of the moments where you have fear uh, by changing the rules a bit, so you work around the moments where you have fear, so that next time the fear factor is less. You're evaluating it and you're getting to a plan that you're really feeling comfortable with. All right. The more experience you have, obviously, the things are going to change. You're not going to be as fearful. You're going to be actually showing more detachment of your trade. You're not going to have that level of attachment to it, the level of attachment to how it develops, the outcome, nor necessarily the drawdown to it. Once you get into a situation that your heart doesn't skip a beat when you're entering or exiting or managing, when you're as cool as you were at any other moment of the day when entering a trade, then you realize you got to a place that you're managing and handling that fear. All right? That's a place where you want to be. Now, that doesn't come easy, but if you got that detachment, that's really a good sign. If you don't, that means you're still excited or fearful or anxious, right? And that could definitely have an impact on how you approach your trade. To get to that stage where you're detached, you might want to think about some ideas like asking yourself, what's the best or the worst that can happen? Literally, what's the worst that can happen? You risked 0.5% on a trade. All right, so in the most likely scenario, the worst that can happen is I lose 0.5%. Or even if there's, the trade closes at slightly unfavorable rate, okay, it's 0.6% loss then. And if you think that that loss is acceptable, then there's nothing to fear. If you don't think that it's acceptable, then you're over risking and you got to do the risk management story again and rethink that part. Every time we enter a trade, the risk should be acceptable. And if you ask ourselves, what's the worst that can happen, then we just need to accept that or don't trade. All right? So that's how you can get to the stage of detachment. When you get to a better stage, we're also realizing everything is a probabilistic approach. One trade doesn't say anything. 2, 3 trades say nothing. Only, at the minimum, we need 30. I think the very minimum, I think it was 30, but let's say 40 to be on the safe side. Then we can say something, because then the probability kicks in of having a string of 40 trades. We can read into it. 5 trades is zilch. No value. 1 trade, same story. 1 loss means nothing. Nothing, 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 nothing. So hopefully we'll get to that probabilistic mindset, and we're flexible, approaching the trading day flexible. The third thing, which you'll probably eventually notice, is that you're trading more on autopilot. The whole idea of thinking during trading is reduced. we're not, at that point trading with a very high level of thought actually. And that might sound funny in a way, but picture, driving a car. When you're driving a car after you've had been driving for 20 years, you're not consciously thinking about each move and action you do in that car. It's all automatic. Well, actually, with trading, uh, that is a good sign because at that point, we're not overthinking our approach and starting to rethink the wheel during the trading day. If we think we want to do it before, a deliberate thinking before the trading day starts and after the trading day is ended. But we don't want to overthink actually during the trading. During the trading, we got a plan, and our sole focus is on executing that plan. We're actually there to react to what's going on and to react in a way, of course, that matches what we had planned. All right, so that actually reduces the stress, makes us more relaxed. Okay, so those are some of the things you'll notice if you got that development. Now, some techniques I wanted to share with you to also get to that more celebrated place of trading psychology when you're trading. At the very top, you see I'm talking about mindfulness and writing down your thoughts. You want to be when you're not actually when you haven't reached the level where you're detached. I mean, I'm not saying that you have to be detached. It's like you don't care, right, at all. I'm not talking about that, right? Just to make sure. I'm talking about getting to a level where obviously you still care about implementing your trading plan correctly. That's what your care should be about, right? If you don't care about that, that's not a good detachment. So it has to be a bit of balance. So if you haven't reached this particular zone yet, let's say zone, how do you get there? Well, actually, you want to be mindful of what's going on. Eventually, you want to be an autopilot. But to get towards the moment where you can be an autopilot, you got to actually measure yourself very thoroughly, write down your thoughts. I know that not everyone is going to be jumping for joy about that. But by monitoring your thoughts and your subconsciousness, you gotta quantify that because otherwise you'll not be able to. After the trading day is over, you're not going to know what to do, how to improve yourself. The key to improving yourself is in the heat of the battle. So you need to know, you need to document that so you can look at that later and say, oh, this is why I'm doing that. This is what's happening. So you got to be mindful when improving, and you got to write down those thoughts. We all want to be focused and aware. We don't want to be heavily distracted. Sometimes it could be good to be distracted if you're overly nervous and you're in a trade and you're trading an hourly chart and you're looking at the 5 minute chart. Well, maybe actually you should distract yourself from that 5 minute chart because you're going to only mess around and hurt your setup, and you're going to hurt your chances of trading that correctly. So, that could be a different scenario. But in generally speaking, of course, you want to be focused and aware of what's going on and really on the ball on details. Often enough, it's about details. It's many times when you're trading, you just generally think, okay, setup is ready. You overlook a detail and you find out later that you forgot that and you're mad at yourself. So be really focused on those details as well. Be focused on high value actions instead of fear based actions. Here are some examples about high value actions. Doing your evaluations, um, trying to have a positive reinforcements of a positive vibe before you're trading. These are all things that contribute to your success. But worrying about a setup on a 5 minute chart, whereas your trade was taken on the hourly, as I said, This is a fear-based action. You're only exaggerating and aggravating that fear. You're only making it worse. You're not helping yourself by doing that, right? So those fear-based actions, we tend to look them up. We tend to seek them somehow. We're attracted to them. I don't know why, but that's just most of the time how it goes. It's like we like to, I don't know. It seems like we get distracted by them. We like to think over and over and over again why that trade was actually not a good trade. That that rehashing over and over like that, that's just a fear-based action. And if you can realize how you spend your time and split them into a high-value action or a fear-based action, you're conscious of the fact that, oh, I'm not being productive at this moment. All right, so make sure that you have fixed moments to monitor yourself during your trading day. Have a checklist. All right, have a checklist with triggers so that you can go like, am I sweating? Am I showing nervous signs by leaning forward towards the PC, right? Am I mentally and physically in a stable, calm state, or are signs of nervousness? If there are signs of nervousness, make a break, take a break, and if the signs of nervousness continue, stop the trading. Have a circuit breaker installed in your approach so that you don't necessarily keep trading when you've reached a high level of nervousness. Okay? So setting up a checklist, making sure that you know when when you're nervous, when you should stop for a break or entirely. You could also have other circuit breakers like standing up, walking away if possible, or just creating a bigger distance between you and the screen. So these are some very conscious things you can do, right? These four that I have a green V next to it. Being mindful, being focused, realizing how you're spending your time, if it's high value or fear based, monitoring yourself, it will really give you a structure that allows you to improve yourself day by day and being able to tackle your fears. And you should be able to see improvement as you go along. But there are also some things that are, let's say, in a different category. One of them is binaural beats. It's an unconscious way to train yourself. All right, it's not something that you consciously do. It's you listen to them, you listen to positive messages, and I, interesting enough, this is going to have impact on your conscious approach as well. All right, so it's a training and rewiring how you approach trading and gives you a positive approach. And I think Nando is going to talk a bit more about that. All right, he knows more about that. So repetition, routine is all good. This will this will make sure that all these things are really solidly in you by doing a routine, by having repetition. You're going to get to a state where this is automatic. Also having fun, treating it as a game, not as something that's maybe not too serious. I mean, it's serious business, of course, but I mean, having a bit of fun is good for the learning curve too. Grade yourself on these techniques and set a target, right? That will help stimulate and motivate yourself. Let's say you have a target of getting 7 out of 10 points on mindfulness on all these categories, right? Okay? And you grade yourself. Today I got an 8, right? I got a 9 here. I got an 8 here and a 7 here. Great, that was a positive day. But the other day I got a 5 and a 6 and a 7 here, but also a 5 here. Well, not a good day, right? So this is how you can measure and motivate yourself to really be good in these things. And you can choose other categories if you like, of course, right? So, oh, I see I passed my time. One more question here. Most of the time, I face indecision problems. How to overcome this problem? Well, you want to realize I cannot give you a blank answer. I mean, a standard answer. Say this is do this, and it's going to work. You got to understand why are you having that indecision? Why at that moment? Think about it. What are you thinking when that happens? Write that down. Do that several times, and start to see if there's any trend, if there's any connection there. Then try to analyze: can you do something different to avoid such a situation? How can you, maybe if you have difficulties with entering the market, you can use pending orders, for instance. All right. So you can use six thinking hats concept, where basically use the six thinking hats is basically you get six hats, different roles, and you look at it from a different perspective at the problem. One is a positive approach, one is more critical, one is solution oriented. You have to Google it, six thinking hats, and you'll find more info on that, I'm sure. If you Google it, that would be a ton of information on that. All right. That's how you really have to approach it from an analytical point. Otherwise, I would have to know more information about why you have that indecision. Just having indecision, you got to know the circumstances and context, and you're the best actually to find out what uh, what ties that and how you can solve it. All right. So I'm going to pass it over to Nenad. Let me see if I can find him, and I'll pass over this screen sharing to him. If you have any questions, of course, feel free to ask us anytime through the chat, like Aleph did. Thank you so much for those questions.
Thank you, Chris. Excellent as always. So, guys, I will continue. I will cut short because Chris has already explained some tips and tricks. And I will tell you basically that we have four most common fears. And those fears are fears of losing money, fears of missing out on a move, fear of letting a profit turn into a loss, and fear of being wrong or not being right. Now, the fear of losing money is actually one of the most common fears, and it has several consequences. Fear of loss will make a trader hesitant to execute his or her strategy. That will definitely lead to an inability to pull the trigger on new entries as well on new exits. As a trader, you need to know that you need to be very decisive, like a sniper, in taking action when your strategy tells you that it's time to enter. I'm not particularly referring to those automated strategies that are not so good in trading because they don't work in the long run. You always need to assess the market in a different perspective. You need to watch for wood, not just a tree. For example, if you read the analysis of euro dollar that I prepared today, I was very clear when I said that it could reject from POC. If it doesn't reject, it will go to 1055. So that is when you take a look at the whole wood. The thing is, that is when you trade. When you see that the market has indeed turned to be bearish, like euro dollar, it does not necessarily mean that it will continue to be bearish, because once it hits important zone that is seen on higher time frames, that could spike the price to the upside, and that is exactly happening at this point. So it's like 25 to 30 pips on this low volatility day, but it's still euro dollar has been rejecting the whole day from POC. That means that actually you take the look, you have taken a look at a whole wood, not just a tree. So the fear of losing money actually should be non-existent, because if you know what you are doing and you don't follow your system automatically, taking every single signal it gives you, you should have at least 2 to 3% of an edge. Now we also have a fear of missing out on a move because every trend has retracement, right? And every trend has always its doubters. As the trend progresses, skeptics will slowly become convinced due to the fear of missing out on profits or the pain of losses in betting against the trend. Well, it's also a sort of greed if you take a wider look. And we know that greed is one of the 4 horsemen of traders' apocalypse. So you should never ever try to jump in a freight train unless you see a valid breakout. That being said, a trade that is basically a happy trigger trade but is actually a breakout on a strong momentum of important daily level, that is okay. But just to jump in when you see that market is moving in a single direction, that's not correct. Although you might have few pips here and there, it doesn't justify that trade from proper psychology perspective. It's a greed because you have the fear of missing out on a move. So when you think to say to the price, get me in, I need to participate in this trend, think twice. Think always twice. You should never ever try to jump in freight trade, as I already said, unless it's a valid breakout. Fear of letting a profit turn into a loss, well, a very, very common fear in traders' eyes and from traders' perspective. One of the most common fears in today's trading is fear of letting a profit turn into a loss, because obviously you don't want to see your money, I intentionally say money, turn into a minus. Well, simple solution, don't look at the money. Watch the pips, guys. If you try to watch the pips instead of watching the money, that will be much more beneficial to your psychology, trader psychology. Because the problem is when you're trading with high leverage, often you will close your trade after 3 or 5 pips of a profit. That's complete nonsense, guys. You close your trade for 3 or 5 pips only if you see that market is not going anywhere, or for example you want to protect your profit, so after 25 pips or 30 pips you put it like break even plus 5, making a profit of 5 pips. But just watching your money in those 5 pips, that's stupid. Imagine, guys, that you have a big account, and let's say that your position is worth $500. So 1 pip is worth $500. In that case, you would be making $2,500 for 5 pips, roughly. Now, obviously, if you say, well, this is a good money, I can buy, I can buy something that I like. For example, you're a fan of Omega watches, such as I am. I'm a big fan of Omega. And for $2,500, you can find a good watch, right? A good Omega. So let's say that you say, okay, in 5 minutes, I have my new watch. Well, okay, you will be happy, right? You will be happy in the first 5 minutes. But during the long run, guys, what if your next trade hits a stop loss? What if your next 5 trades hit stop loss and you only have 3 wins for 5 pips? It doesn't justify you to being a good trader. You're not a good trader if you do that. You made money. You bought your watch. Maybe you can buy a car for $5,000 or $10,000, right? But in the long run, you will lose. Because if your risk is 30 or 50 pips, and you are constantly aiming to make 2, 5, 6, 7, 8 pips, that's not good, man. That's not good. Because for one loss, you need to make 4 straight wins. And who guarantee you that you will make a win every single time after a loss? The solution is don't watch your money and lower your risk. You can buy your watch after 2, 3 months of trading. You don't need to buy it instantly. That was just an example, because like 6 years ago I was trading in a firm. I was a head trader of a UK firm, and to be honest, there were a lot of people there actually, and I saw a lot of different styles of trading. Simply said, I don't have the nerves to look at my huge profit turning into a loss. Because of that, I have adopted a simple solution, and that is called lowering the risk. Always think that banks give you 1 or 2% per year. And if you're able to make it per month, you ultimately you will be dozen times better than bank. That's good, guys. That's excellent. And finally, fear of being wrong. No one likes to be wrong. No one. It pulls our ego in. If you make it a point to observe being wrong in your day-to-day life, you will hear people making excuses all the time to sidestep taking personal responsibility for mistakes, even insignificant ones. Many times, traders will admit that being wrong is one of the toughest fears for them to overcome. Okay? What will you say to your wives, husbands, friends, or important people in your life? Well, you need to say, I was wrong. And it's good to admit it. Because when you admit that you're wrong, you can identify your problem, your psychological problem. You need to consider different psychological aspects and to deeper study your own psychology. Because your trading behavior will affect your trading performance. I have heard a lot of times good, successful traders say, I'm worth peep. I won't say that word, but you know what I mean. Even excellent traders say that. Because they still have that fear of being wrong. What should I say to my trading buddies? Okay, then what should I say to my wife or my friend? Simple. I was wrong. There is nothing wrong in being wrong. Because if you assess your mistake, you will ultimately find the cause for that. And next time, you will be more careful about making that same decision you made when you were wrong. Symptoms for all these things: cutting winners short in a fear of giving profits back. How many times you have done it? Well, guys, lower your risk. It's simple enough. Forget about huge profits. Forget about 10 pips and $2,000 of profit. Make your 10 pips worth $20 or $200. Forget about huge profits, because if you think about huge profits, you will always cut your winners short. Unless you have an abnormal amount of money and you can risk thousands and thousands in a single trade. But it doesn't justify you to be a good trader even if you have that kind of money. If you have that amount of money, guys, please listen to me. Be smart. Forget about telltales. Forget about bragging. And yes, it's a good thing now to mention that this Sunday I will publish a blog where I will show you how women can actually be better traders than men. Because women don't have the problem of men testosterone. You know, when you brag to your friends, I was right, I made 200 pips. Or you go to Forex Factory, Euro Dollar Thread, and read hundreds of posts that no one loses and everyone is right. Stupid. Simply, that's a man thing. And yes, women can be better traders than men. So don't be afraid to lose, but if you lose, do it with a low risk. Because you will have the chance to recuperate, and you will have the chance to make 2 or 3 more trades during the same day. You won't be over-risking. Hesitating pulling the trigger because you fear the prospect of a loss. Indecision problem. Alif, that is your problem. That is your indecision problem. Why are you afraid of a loss? Do you have a demo account? Try to practice it. Then after you practice on demo, place $100 on your account. Go with micro lots. Go with nano lots, 0.05. That way you will be trading with a low risk and you won't be hesitant to pull the trigger. You're hesitant because you're afraid that you will lose. But how much can you lose if you risk that small amount of money? Even if you lose it, it's still nothing. You will pay for one dinner that amount of money. But it will be good for you because you will learn that you actually can do it without a fear next time. So next time you will be making, maybe you will be depositing like $10,000 and you will go with 0.3 lots because you know when you open 0.3 lots, you won't have the fear of loss. Forget about fear of loss. Everyone loses from time to time. I lose also from time to time. It's normal, guys. And my biggest losses are not because I'm wrong, for example, like 20, 30 pips. My biggest losses come if I try to over leverage the trade. And 90% of my mistakes is over leveraging. Everything else is great. Stop losses, entries, exits, everything is fine. But when I think, okay, I made like 60 trades in a row without a loss, sometimes it pulls you in and you say, okay, next trade will be 5 times more the risk. And usually that trade is a loss. That's happening. So the cure for that is try with a low risk. I already explained you how you can make 1,000 euros for 300 euro dollar account. And now we are in process to making it to 5,000. But it will take some time. Because if we pull and put the whole margin in our trade just to prove you that we can make 4,000 in 1 month, that wouldn't justify us being a good trader. Because we will be over-risking. Listen to me. From 300 euros to 1,000, 1,500, it's okay. But if you have 1,500, you think, okay, now I can open a full lot and I can make 3,000 in a single month. That's a mistake. Don't do that. Think always from a perspective of professional bank trader. Don't be a simple retail trader. Be a bank trader. Be institutional trader. Low risk, guys. Proper institutional traders do it with a low risk. It's the politics of the company. And if you break the rules, you're out. You don't work as a trader in the bank anymore. Unless there was an example of Societe Generale trader like 7, 8, or 10 years ago, and he was so good, and basically one of the bank officials gave him free hands and free will to do whatever he wants. And of course, he lost. And that has put Societe Generale Bank, I think it was Societe Generale, I think, or Hippo Bank, I'm not sure, but one of those two banks, and they went almost bankrupt because of that trader. They made a huge loss because he had his own will. Guys, if you trade for the company, there is no free will. Yes, Alif, 25 to 30% for a year is excellent. And I've shown you, and I can always show you my statement where I made 30 or 40%, and I stopped trading that account. I don't trade it now. I'm okay. It's good. Believe me, it's good. Because if you make 25 to 30%, you will be in 5% of traders that actually make money in Forex market. Okay, so guys, these are all symptoms, and you are recognizing yourself in these symptoms. Forget a perfect trade. Forget about it. There is no perfect trade. There are only trades that are good or bad. Sometimes even good trades, even bad trades can be good trades. It doesn't matter. You lost because, well, there was a rumor in the market. And you didn't lose because your analysis was wrong. Do you really think that all people who lost their money when Swiss National Bank unpegged the euro from Swiss, do you really think that they were all bad traders? No, they were great traders. Most of them who had been making money for 4 or 5 years prior to S&B scandal, all of them were perfect traders. Guys, because they have been running long-term positions and they were making thousands and thousands of pips. A long-term trader. I'm not a long-term trader. I am a short-term, intraday to intra-week trader. But I can say those guys that were hanging on to their winning trades, that was not their fault that they lost it, guys. So sometimes your bad trades are actually good ones, and you are not. It's not your fault. Focus on the process. Focus on the pips. Don't focus on making money. Focus on making pips. Increase the risk slowly. As your account progresses, you can increase lot size. Not just the risk, but lot size. So instead of 0.3, you can go with 0.6, 1% of risk. And take occasional breaks. Step away from the screen. That will help you. If you don't handle your own emotions, fear will carry over to next trade. It means fear will carry itself over to next trade, and you will be paralyzed to make a trade. Good traders make the opposite. I mean good traders. Traders who have good self-confidence. Traders who've been like a couple of years in the market full-time or longer term, they can make too many trades because they are overconfident. Fear kills the opportunity and greed blinds us to danger. Okay, this is simple truth. And sometimes remember, less is better. How to overcome the fear? Follow the strategy which unemotionally tells you when to enter and exit. Lower your risk. That is the most important part. Use visualization techniques to take away focus from the possibility of losing. Think about positive results because universe is energy, right? Invisible cords of energy. Positive thoughts bring positive things. So use visualization techniques. Try to visualize the current position becoming a big winner, a grand slam. Like Novak Djokovic, you know, the best tennis player in the world. So visualize a grand slam, a smash. Game, set, and match. think that your trade will be good. Don't think that your trade will be negative. Don't think about it. Because if you think about it, you might cut your trade for a few pips, or you might let your trade run just to pray that it will eventually turn out. Use stop loss and think positively. Okay, guys? So, now, question. What is the worst that can happen? Well, guys, the worst that can happen is stop loss. Is it really hard to accept it? Stop loss, translated to Forex terms, means stopping the loss. So you are stopping the loss. Are you really that of a gambler that you don't want to stop your losses? Guys, when you wound yourself, for example, when you cut yourself accidentally, let's say, with a knife when you're making dinner, whatever, are you trying to stop your bleeding? I know that you are, because that's normal, right? You don't just let the blood spills to your dinner, right? Because you cut your finger. You're trying to stop your bleeding. The same is try to stop your account from bleeding. That is called a stop loss. So stopping the loss. What is the best that can happen? Think about it. Grand Slam. Wimbledon. Grand Slam. Target price hit. If you can accept the worst, you should not take a position. If the worst happens, you will still be okay, because there will be nothing to fear of. Think about it. Open a small account and trade micro lots. And think about this. If you can make the profit within the risk limit, you can do the same with more money. If you can make the profit, guys. Because if you can make the profit with $100, $300 account, it means you can make profit with $3 million account. Just if you follow these rules. Risk is fixed. You can go with a slightly high risk, but always stay within the risk threshold. If you cannot trade consistently with $50, believe me, guys, you won't be able to do it with $1,000. And try to use scaling in. I always suggest, try to use scaling in. Divide your positions into 3 smaller positions for the same trade. That way, you're lowering your risk, you're keeping your stop loss the same, and eventually, if the price pulls back more and you open another position, it will exponentially go up. Alif is asking, for newbies, they fear on holding trades overnight. Is it better to close trade before the next day? Yes, Alif. If you're a new trader, close it and don't keep it overnight. As your trading career and trading development progresses, you will learn that you can actually hold your trades overnight. But if you are a new trader, then don't do it. Okay, guys, this was it. I hope that you have enjoyed. And this is my final part. Open a small account. Guys, don't be afraid of losing the small account. Start from smaller lot sizes. Risk 0.5 to 2% maximum per trade and 3% per day maximum. Reanalyze your whole trading psychology from grounds up, especially if you make a trade and it is a loss. And Trading in the Zone by Mark Douglas. Don't forget the good book. Yes, Ilya, my yesterday webinar will be uploaded. I think it's uploaded. So please check it. I think I have uploaded yesterday. So it should be on Admiral Markets website. It's Murray Matt, Price Action Training School. So yeah, just go there and listen to it, because I think, yes, I have already updated it. So guys, thank you for listening. As always, for all of you who are celebrating Easter, happy Easter, and don't forget that we are here with you and we always want to help you. So guys, as always, cheers and trade safe.